Now, as we mentioned earlier, the central bank has cut interest rates twice this year. But how are these rates affecting the property sector? Joining us live to talk about this and more is Delfin Angelo Wenceslao, or Buds, the president and CEO of leading property developer Wenceslao and Associates. Hi, Buds.
Hi, Maiki. Thanks for having me.
We're happy to have you here with us, especially to talk about all these changes in the macroeconomic fundamentals and how they're going to affect your sector. So much has changed, and just in the second half of 2024. Just yesterday, the BSP cut interest rates again by a 1/4 percentage point. This brings us to 6% already. This amid cooling inflation, the lower reserve requirement ratio for banks, and steady economic growth. How do you see all of these changes on the macroeconomic landscape affecting the property sector?
Well, the Philippines real estate is actually entering a renewed growth cycle because of managed inflation and lower interest rates. I think last August was the first rate cut they did. They also announced one again yesterday. I think with this, with increased consumer spending, it will help retail. It will lower down mortgage interest rates for residential buyers. And for new construction, it will also lower construction loans.
Mm-hmm. That said, how are things shaping up for 2025?
So at least for us, we're pretty excited. This is actually Dmws' biggest leasing year. So we're currently still increasing our recurring income projects. We're actually going to launch our next 2-tower office project, Asiana Plaza. We're about to launch our build-to-suits for our medical facilities and educational facilities. And we're actually about to launch also a new 200-unit co-living/affordable housing project.
Okay, interesting. Going back to the industry, what are the trends that you're noticed in the construction and property development industry, given the shifts on the macroeconomic front?
So remote work is still there, but I think there's a lot of opportunities tied to that. Pre-pandemic, there's always been this sense of building livable, walkable communities. During the pandemic, there was a rise of 15-minute cities and having essential goods and services being nearby. And now we're seeing a lot of talk about resiliency. And I think all of this is tied up. That's why, at least for DMW, we see a big advantage in doing mixed-use master plan communities, which further adds to the holistic development of Asiana City.
Mm-hmm. Another trend that emerged post-pandemic is the demand for remote work. How does that affect, how do you think that's going to affect leasing in the property sector in general?
So with that and new supply, it actually had a detrimental effect in terms of vacancy. But I think it also gave an opportunity for developers to build more experiential spaces. What do I mean by that? I think office people, decided that they don't just want to cram into these air-conditioned boxes. So developers are now putting up, I think, more spaces which enhance collaboration, interaction, and community building.
Okay, and that's big for the leasing market. They don't just want these air-conditioned boxes. What more do they want?
So even for us, pre-pandemic, we saw this already. That's why we never stopped building during the pandemic. We launched our 5-hectare, 70,000 square meter mixed-use project, Paracal. It's a mix of retail, public space, and office. And we've seen increased take-up of that. That's actually contributed to a lot of the take-up from our current supply right now in 2024.
Okay, so coming into 2025, where do you see the demand in the property sector?
So for us, there's been renewed interest, specifically coming from the shipping and mining industries. Actually, they took up about 60 to 70% of the supply we gave up. We see again that there's a flight to experience. They're coming from much older buildings and they're seeing this new space. There's plazas, spaces for wellness, for sports, for collaboration, and that's what attributed to a lot of the take-up that we've seen.
Expectations and standards have gotten much higher, and also everything needs to be Instagram worthy.
Absolutely.
Okay, now going back to your particular company, DMW started in the 1960s as a general builder and contractor, but you built your reputation as a reclamation specialist. But since then, you've diversified into property development with the 107-hectare Asiana City. What's the thrust of the company now?
Being a 60-year-old construction company, we've seen the peaks and valleys in terms of the cycles of construction. So for us, real estate was a way to basically level that off, to make it more consistent, make it more predictable. So right now, we're still focused on building our recurring income projects. That's why we're focused on commercial projects, namely office and retail. And I think for the next decade or so, we still have a lot of land bank left. We're just going to continue to lease, sell, and develop that land bank.
So complete shift away from the reclamation work that you did about 20 years ago.
Yeah. So, for us, in the end, real estate is about location, location, location. And we have one of the largest contiguous land banks left in a prime location in Metro Manila. So I think for us, this is where the alpha is.
Correct. ASEAN is home to the City of Dreams, Ayala Mall, Singapore School, numerous condos, and St. Luke's Hospital, which is under construction. When's that going to be finished?
So they're about to start construction. So we're expecting about 5 years' time.
5 years' time, we'll have St. Luke's in Asiana City. All right, interesting. You also have 30 hectares left in Asiana of undeveloped land. What do you plan on doing with this?
So at least for the next year, for the next 5 years, we're planning to continue our office projects, namely Asiana Plaza. That's a 2-tower, 80,000 square meter office. We're planning to do build-to-suits for medical facilities besides St. Luke's, and for co-working and co-housing projects.
Okay, now let's go to the numbers. How has 2024 been thus far? From the first half to the second half, given all these changing macroeconomic fundamentals?
So first half, year on year, we've actually had our biggest leasing year ever. We've been able to increase our recurring income contributions by 34%, increased our occupancy from 50 to 80%, and our recurring income contributions have actually increased to 86% from last year.
Now, in 2023, you had 1.7 billion in core earnings. Now, for 2024, I know you're expecting double-digit growth. Where's that growth going to be coming from? And are you on track to hit your target for 2024?
We're actually exceeded our targets already in terms of leasing. So right now, we still have about 50,000 square meters of leasable area left. So I think that supply will be enough for us for the next 1 or 2 years, and that's where most of the growth will be coming from.
Okay, so 2024, double-digit growth. 2025, double-digit growth as well?
So we're hoping and expecting that with the new office spaces that were coming up, that's where most of the growth of the company will come from.
Okay, in terms of capital expenditure, historically you've been spending about 3 to 4 billion pesos in capex. 2024, 2025, are they going to be any different?
They're going to be this more or less in line or the same with that. We don't want to sacrifice our profit margins for growth, and that's where we see where the sustainable take-up is in terms of that capex expenditure.
Specifically, where are you going to be spending that money on? 3 to 4 billion pesos in
So
capex?
it's mostly still going to be recurring income. We still want to keep that 50 to 60% recurring income contributions. It's mostly going to be from projects that are going to be for lease.
All right. Looking at your 5-year pipeline, what are the top projects that you want to roll out?
So our next 5-year pipeline is actually Asiana Plaza. So those are 2 towers. And again, we're building out our next developments in terms of our co-living spaces. That's a 200-unit. That's about to break ground by first quarter of next year. And we're also planning our own co-working space as well.
Okay, now also recently you partnered with Meralco's Empower for Energy Solutions. Talk to us about the benefits of this collaboration and meeting your ESG commitments as a publicly listed company.
So, real estate is probably attributable to about 30% of the carbon emissions globally. They also use up 40% of the energy requirements of the entire world. So for us, as a publicly listed developer, we don't just see it as the right thing to do. We see it as the smart thing to do. We saw the volatility that happened during the energy rates and during the pandemic. So it's also a way for us to help our multinational clients reach their own green emission standards as well.
All right, well, you built the city. Now it needs to be powered continuously. All right, thank you so much, Buds Wenceslao.
Thank you so much, Maiki.
And that was Delfin Angelo Wenceslao, the CEO and President of Wenceslao and Associates, sharing his insights on the property sector and much more with us.